Hi everyone, welcome to my channel. I'm Doris, and today let's talk about the U.S. Stock market. All three major indexes fell more than 2% this week, and the U.S. stocks closed mixed on Friday, with S&P falling the pullback zone. All three major indexes fell more than 2% this week, and the markets focused on big tech stocks like Amazon. The U.S. core PCE data rose 0.3% in September, in line with market expectations, and personal spending rose more than expected. The S&P 500 is down more than 10% from its year high on July 31st, officially entering the pullback zone. Bank of America analyst Michael Harnett believes this S&P 500 has fallen below the key 4,200 mark and could dip further until 200-week moving average of 3,941, which means the index may have 5% upside. Sonia Meskin, head of the U.S. macro at the Bank of New York Mellon Investment Management, said, "The market is likely to decline further and there's no stop of a rebound at the end of the year. We're actually not so optimistic about the stock market. Our core estimate is for the S&P 500 to end around 4,000, but she admits that there is some uncertainty about the prediction." The market continues to watch U.S. earnings. E-commerce giant Amazon beat revenue and earnings expectation in the first fiscal third quarter. Intel's third quarter revenue and adjusted earnings per share beat expectations, and further guidance beat expectations. Ford Motor Company closed sharply down 12.3%. The company reported weaker third quarter earnings expectation on the auto workers' union strike and lower guidance for the full year. Oil giant ExxonMobil missed its adjusted EPS in the third quarter and raised its quarterly dividend. Its free cash flow has far exceeded market expectations. Chevron closed down 6.7%, well below a year earlier as the revenue fell of 18.8% from a year earlier, but still beating market expectations. Non-GAAP earnings per share was below market expectations. Analysts say that 78% of the companies that have reported reports so far beat expectations. But a growing number of companies say consumer demand is falling and the economic environment is deteriorating. The U.S. PCE index is a key measure of inflation, and it's more accurate than CPI as believed by Federal Reserve because that it takes account of the substitution items. It rose 0.3% in September from the previous month, in line with analysts' expectations led by the Dow Jones, and up from 0.1% in August. In September, the core PCE index rose 3.7% in September from the same period a year earlier. The report also showed that even though prices rebounded, personal spending rose 0.7%, even better than the forecast of 0.5%, confirming the strong consumption momentum noted in the GDP report. The inflation adjustment PCE price index recorded 0.7% month-on-month in September. The PCE indicator favored by the Fed, which measures underlying inflation, accelerated to a 4-month high in September, boosted by a rebound in consumer spending. If that rally continues, the Fed could raise interest rates in the coming months. The Fed preferred inflation indicator, core PCE, rose 3.7% year-on-year, as a level that policymakers expected the measure at the end of the year, reinforcing the market reaction. But alarmingly, personal income growth has fallen from 0.4% to 0.3%, which is less than expected, and also less than 0.4% CPI growth in September, suggesting that consumers are being squeezed, raising questions that the strong pace of spending will continue. The Fed will hold its monetary meeting next week. The Fed is widely expected to keep its federal funds interest rates in the range of 5.25% to 5.5%. Though Federal Chairman Jerome Powell has said a strong economy and a tight labor market could give the Fed a reason to raise interest rates further. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.